All right, hey, good afternoon, everyone. It is about 2 o'clock on Wednesday. Let's take a look at the trade action so you can see what happened today and kind of how we're viewing it. Obviously, there's been a little bit of strength in the corn market, so we'll talk about that, and we'll look at all three of the grains. Now, remember, from a big picture standpoint, we are looking for corn and soybean carryouts to expand this year. And what we've been saying for several weeks is that one of two things has to happen in order for those carryouts to not expand. And the first is we could see a resurgence of demand in the corn or bean market, or we could see weather take yield away or take supply out of the picture. And that's kind of what the market's looking at today is, hey, there's a little bit of dryness, maybe a little bit of heat, and oh my gosh, we're going to have a 100-year event drought, and so we need to price all that in right now, and we need to scream higher. And no argument from us that if we do see a 2012 type drought where we burn up Iowa and Illinois and Indiana, then yeah, we're going to go higher because that's going to shrink our carryout. But until and unless we see that happen, I think rallies are for selling because we don't see anything longer. We don't see anything in the forecasts, or we're not reading anything that says, hey, our yield is in jeopardy, at least not yet. Now, obviously, that's subject to change, right? Because if we don't get rain, then we're going to have a problem. That's like duh. It doesn't make obviously that happens. But if that does manifest itself and that does become true, what will that look like on the price charts? Well, it's going to look like this. You're going to see prices start to knock out highs. You're going to see small retracements, and you're going to see those get into higher lows, and you're going to see new highs get taken out. So you're going to have a series of higher highs and higher lows that start to get taken out, and it's going to look the opposite of this, which is a series of lower lows and lower highs all the way back into February. And so a forecast or two does not change a trend, and a day or two does not change a trend. So as of now, these markets are in downtrends, and they're going to continue to be in downtrends until price action says otherwise. So look at soybeans, okay? This is old crop beans. You can see this move lower. We've broken the base channel. We've now consolidated for 4 or 5 days right underneath it. We have yet to hold this lower boundary of this base channel on a closing basis yet, and so lower we should continue to look. I don't know where the floor of this goes, but if the balance sheet is going to swell as much as what the USDA says it could, and as much as the Brazilian crop says it could, and as much as the demand weakness says it could, then we could see this drop from 13 all the way down to $10, $11. I mean, we could go much, much cheaper based on these targets. So there's no reason for us to look anywhere but lower on the soybean market from our perspective. Now let's look at new crop. New crop is even weaker than old, right? You have a series of lower lows and lower highs. You're below the base channel. Yes, you can make an argument that we're oversold, but we've talked about this before too, that markets can stay oversold for a really long time. They are not required to come back up. Just because a technical indicator says the market should do something, that does not mean the market has to listen to it. The market drives itself and indicators follow it. It's not the other way around. So until we see price action start to take out highs, we are going to keep looking lower in soybeans. In fact, I wouldn't be a bit surprised to see us just kind of roll over and march ourselves lower. And we're still looking all the way down into the mid-10s on this new crop contract before we think this move is done. I don't see any bullish divergences. I don't see any reason to think that that's going to change course anytime soon. And of course, if we do get something fundamentally that implies that, it will show itself right here by taking out highs, holding support levels, and then up we go. And we'll have plenty of time to react to it. But I don't think that today is that day. Okay, well, what about corn? Surely corn has to be bottoming because, I mean, look, we have a little stochastic divergence. We have a little RSI divergence. Well, kind of, but let me show you why I don't love RSI and stochastic divergences and why I prefer Dr. Elder's force index. The reason for that is because it has this 0 line on the force index. These other indicators don't have it. And the reason that that's significant is that you really can't get a divergence without breaking the zero line. That's one of the rules of divergence from if you study Dr. Elder, and we have not received that until today. We broke the top of it, but we have lower lows as we've come through. We never broke it, so this is not a divergence on the force index, even though it looks like one on the RSI. And now we're just into sell territory. So we're on top of the zero line, which is a textbook sell. We're right below resistance. We have yet to take out anything significant on this chart. So we are looking for lower prices in December corn, and we're not looking for higher prices. You can see the long upper shadow, and then obviously our simplest test and our biggest litmus test is we're below this hedge line and we're below where we were 26 days ago. Until those two things change, we're not looking higher on December corn. And if we do rip higher, let's talk strategy just a little bit. You know, what's that going to look like? Well, it's going to look like big bars that go up, and it's not going to go straight up forever. We're going to get selling. And what we're going to do, if we break our hedge line, and we may or may not wait for us to get back above where we were 26 days ago, but what we will do is we will buy a call either at 550 or 580, and we will sell a put down here at $5 or 510. So we'll sell a put at the bottom of the range, we'll buy a call up here, and we'll capture the move to the upside. And then if we turn back around, if we put the position on because it moves up here, and remember, we're still bearish, so we're going to hold those short futures. And if we come up here and reverse and come back down, we're just going to take that put right off. And then we're going to be in a nice spread with long calls, short futures, and then we'll just give it time and see what happens. So because we're not going to try to be perfect right through here, and our goal is to minimize any whipsaws that we might get. So that strategy does that for us. It's not perfect, it's not a guaranteed result, but if we do get higher, at least we'll participate in some of it or in most of it if we go a lot higher. But if we turn around and just rip lower, another dollar, because we're going to have a 2.5 billion bushel carryout, then we'll at least capture that as well, and we'll have minimal damage from this little consolidation period and this any whipsaws that might happen here. So that's the plan as we move forward, right? We're just going to hold hedges. If we get up above our hedge line, we'll put on a call. We'll put on a spread strategy that will capture the upside, and we'll take it back off if we get back below our hedge line. Super simple. Let's not overthink it. Let's take it a day at a time. Let's not try to be weathermen. Let's just follow our hedge line. Let's let the system do its job, and let's just let price action tell us what we need to do. All right, Kansas City wheat. Here we are in Kansas City wheat. It's not bullish. There's nothing on this chart that screams buy me. We had our shot at higher prices. The market took that away. And we've collapsed back down to the bottom end of the range. Chicago really tested the $6 level today. And remember, a $2.12 premium Kansas City to Chicago is a really wide spread. Typically, Kansas City likes to rest 50 to 90 cents above Chicago, and we're more than double that. So you can see Kansas City really roll over. And remember, Kansas City's in terrible shape, right? Huge abandonment, big drought, low yields, few acres, worst crop we've had in 100 years. I mean, it's really, really bullish, and Kansas City is just saying, we don't care, we're going to go lower anyway. So remember, these are futures markets, not present markets, and the fundamentals that we know about are not really the primary drivers. It's the ones that we don't know about that are driving it. And from our perspective, this looks like we are heading lower in Chicago, in Kansas City wheat. Obviously, where we are is fully hedged. Depending how long people have been with us or whatever, we're hedged from higher levels. I don't think I have any floors that are worse than $8 a bushel, which is very profitable. And we're looking to probably set some pricing on 24 wheat as well, because this just could get really ugly, particularly if corn. We're really bearish new crop or old crop corn. If it really does roll over and fail from this level, we're looking $1 lower. We're looking to the low fives, probably down into this type of multiple down here at 520 to 510. That's really kind of what we're looking at. So you have an acute risk reward right here up into this resistance level. You've got chart resistance here. You've got all this stuff right in here, and you've got our hedge line in the daily cloud. You got lots of places to know where you're wrong, and you've got lots of upside potential if you're looking to spec that market. So in our view, that one's ripe for the picking and should probably not be ignored. And I definitely don't expect the funds to ignore it either, just because of some weather forecasts that may or may not come to fruition. I think that they're probably going to jump on any sign of moisture and push this thing quite a bit lower. All right, that's where we're at. No change from our perspective. We are going to be hedged. We are going to be very, very careful to come out of those hedges, and we're going to use strategies that allow us to capture the upside, but don't remove our downside protection, because we want to minimize the risk of whipsaw there. Hope that's helpful. If you have questions, call us. Remember, there is risk trading commodity futures and options. There is no guarantees in this business, and so you've got to be acutely aware of what that risk is. You've got to trade within your own financial wherewithal and circumstances, and please, please, please ask questions and learn. And we're happy to help, and we're happy to help you create positions that that would be beneficial to you. Have a great night. We will talk to you later.